It's not all about your credit score. How are you guys doing today? My name is Apple, and today we are filling in the financial gap between schools and the real world. And today we're talking about are the 5 C's of credit. So these are the 5 things that a potential lender is going to look at when they're evaluating you on an investment. And this is a video to show you guys that it's not all about your credit score, and that it's actually looking at a much broader picture when someone's looking at whether or not they're going to lend you money, whether a bank or a private lender or anything like that is looking at whether they're going to lend you money or not. This is a very, very important thing to look at, whether you are looking into getting a mortgage, buying a car, getting into real estate. All of that stuff is going to require you to probably get some outside money. So it's very important to know what they're going to be looking at when they're thinking about lending you money, so that you can be sure to maximize these things and make sure you're doing them all right, so you can give yourself the best odds for the best acceptance rate, the best interest rates, all that good stuff. So be sure to stick around, share this video with a friend, leave a like and subscribe, and let's get into it. So the 5 C's of credit are really just a way of a potential lender evaluating you as a potential borrower. So these are the 5 things that lenders are going to look at when they are considering whether or not to give you a loan. So the first one is character. So this might be the most important, but the first one is character. So the character is really all it is who you are, what you have done in the past, and basically what they're looking at is your credit history. So this is where your credit score fits in. Credit score falls under character. So they're looking at your credit history. They're looking at how you have repaid people in the past, what your credit score looks like, what kind of things there are in your credit report. Have you filed for bankruptcy? Have you paid all your loans on time? All that good stuff. So that is all going to be in your character, your credit report, your credit history. Additionally, your reputation, your track record. If you have a good relationship with your bank, if you have a good track record of making good on your promises to pay them back, all that good stuff. You got that relationship going with your bank. That's going to be great for your character. That is going to make it a lot more likely that a lender is going to want to lend to you if you have a good relationship with them. And like I said, with your credit report and your credit score, you got to make sure that those are good, because that's going to be the first thing the lender looks at when they're thinking about giving you a loan or not. And again, remember the 5 factors that go into your credit score. Made a whole video about how to improve these 5 factors, but again, just to repeat what they are, the first one is whether or not you pay your loans back on time, whether or not you pay back when you say you're going to pay back and what you say you're going to pay back. Next one, your credit utilization. So how much of your available credit are you using every single month? Are you maxing out your credit cards every month, or are you using a small fraction of what you could be? The right answer is to use a small fraction, because that's going to boost your credit score significantly. Next one is your credit inquiries. So are you going out and trying to get new lines of credit every single day, or are you waiting like 6 months between when you apply for new lines of credit? You should be waiting. Next one is the length of your credit history. So how long have you had these different lines of credit? How long have you kept them open for? So you want to keep your lines of credit open even if you're not using them that regularly, just because that does add to your credit history. And the last one is your credit mix in use. So how many different lines of credit do you have going at a certain amount of time, at a certain time? Are you able to keep track of all your different loans and pay them all back on time? That is what credit mix and use is about. So if you maximize these 5 factors, you're going to have a great job maximizing the character aspect of the 5 C's of your credit. Now let's move on to capacity. So capacity is a measure of your ability to repay this loan. So when a bank goes out and they give you some money, they are going to want to know that you are going to be able to pay them back, that you're going to have the funds over time to be able to repay this money that they're giving you. So what they're going to look for here is your debt to income ratio. So your DTI, if you've heard of that before, DTI, that is your debt to income ratio. So how much debt do you have per how much income you're making? So an ideal debt to income ratio is low. You want to have low debt and high income. So that's going to give you a low debt to income ratio. So essentially, if your debt to income ratio is below 36%, you're doing pretty good. You're doing all right. If it's above 43%, you're going to have a hard time getting a loan. So if you have a debt to income ratio of 43% or higher, you're really going to have to work on getting that down before a lender is going to want to allow you to get more debt, because they don't want you going even higher than that. That is a threshold that they don't want you to cross. So if you're somewhere near 43%, somewhere in the 40s, you're definitely going to want to work on reducing that before you apply for more credit, because lenders are not going to want to see that high debt to income ratio. And additionally, in your capacity, they're also going to look at your job history and your job stability. So are you able to hold down a job consistently? Are they going to have to worry that you're going to get fired, they're going to get laid off, and that you're not going to be able to repay them anymore because you don't have the income to do so? So what capacity is really about, just how able you are to pay them back and how your current income situation is looking. So if you have a solid W-2 job that is paying you a good amount and you're not in too much debt, you're going to have a great job getting capacity knocked out of the park. Next one is capital. So what they're going to look at capital is how much skin you personally have in the game. So when it comes to, let's use a house as an example. Capital in this case would be your down payment. So if you make a high down payment, there is a lower chance that you are going to default on this mortgage because you have more skin in the game. You have put down a lot of your own money into this house, so there's a much lower chance of you just walking away from it because you have all this money you have personally invested. Whereas if you bought a house with, say, like just a couple percent down, so say you bought a $100,000 house for like 2% down. So you paid $2,000 into this house, you borrowed the other 98 grand, and that gives you a much higher incentive to just walk away because you don't have that much skin in the game. And banks know that if you personally have put a lot of money into this investment, into this asset, then you are much more likely to stick around even through tough times because you are personally invested into this. You have more skin in the game than somebody who has a lot less, say like a 2% down payment. So the capital aspect really just shows how serious and committed you are to your loan, to what you're borrowing for. And banks, again, they just want to see that you have a high capital, you're very serious, you're very committed to this investment, and you have a lot of your own money on the line. It's not just their money. They don't want you to just be playing with their money. They want you to have your own money in the game as well. So that is where capital comes in. Now we're going to move over to collateral. So collateral is very important, and it is something that I really don't have right now, which is very unfortunate because I'm in the process of trying to get involved with some real estate investing, but because I do not have significant collateral, I am having a hard time doing that. So let me talk about collateral a little bit. So collateral is what happens. So collateral really answers the question of what if you don't pay? What happens if you don't pay this lender back? So collateral is what the bank wants to see because they want to know that if you don't pay them back, there's something that they can get paid back on themselves. So what this means in context, say you're getting a mortgage on a house, in that case, the house is the bank's collateral. So they know that if you stop paying this mortgage, they can actually foreclose on your house, take your house, and sell it to get back the money that they lent to you that you were not able to pay back. So they know that they have that collateral in your house. Same thing goes for like an auto loan. The collateral is in your car. So all of these things are collateral that the lender can seize if you stop paying them, if you decide not to pay them back. They want to see that they have something that they can seize and sell to sort of make back what they lent you. So because I don't have any big assets right now, don't have a house, don't have a car that's worth very much money at least, the bank is not going to see any collateral in me, so they're not going to be able to offer me a lot of credit. And with collateral, there's two types of credit that a bank or a lender is going to give you. There's secured credit and there's unsecured credit. So what secured credit is it is, say, a mortgage or an auto loan. Secured credit is something where there is collateral on the line. Their loan to you is secured by something tangible, by a house, by a car. And then there's also unsecured credit. So unsecured credit is the opposite of secured credit. So there's nothing tangible behind that credit. So unsecured credit is, say, the bank just giving you a credit card or a line of credit. There is nothing secured with that credit card. There is nothing secured with that line of credit. So if you don't pay your credit card bill, there's nothing they can seize. There's nothing the bank can seize in order to pay back that money that you owe them. So that is the difference between unsecured credit and secured credit. And banks really prefer secured credit because they want to know that even if you stop paying, they can still get paid for the money that they lent out to you. And that is really their safety net. So they want that secured credit, they want that collateral, so they have a safety net if you decide to stop paying them. So that is your collateral. Lastly are your conditions. So the conditions are like sort of the terms of the loan. So the more effort you put into maximizing these top four, the better the results on your on conditions are going to be. So the conditions include like your interest rate. So if you do a good job at cultivating these 4 guys, then your interest rate is going to be significantly lower than somebody who, say, doesn't have a good credit score, doesn't have a solid job behind them, all that good stuff. So that your interest rate, how much money they are actually going to lend you, if they accept you or not, these are conditions as well. Additionally, in conditions, they want to know what it's going to be used for. So the bank wants to know what you're actually going to be putting this money towards. So is it an auto loan? Are you going to buy a car with it? Is it a home loan? Are you going to buy a house? Is it a mortgage? Stuff like that. They want to know what you're actually using this money for, and so that they can see that this is something that's actually like legit, and that you are going to be able to pay them back with this thing, that it's secured, all that good stuff. So you're looking at like a home or an auto loan versus like a signature loan. And a signature loan is, again, something that is not for a defined purpose. So with a signature loan, there's not a lot of like information or like restrictions or stuff on that. So banks really prefer to give you a loan on stuff that has a defined purpose, and so that they know what you're actually using it for, and so that they know what they have the right to sort of seize if you decide to stop paying them, again, going back to collateral. So these are the 5 C's of credit, and these are the 5 things that you want to make sure you are maximizing when you are looking to go out and get some loans from a bank, from a private lender, all that good stuff. And it's really important to start cultivating these things at a young age, because it's so much easier to do so when you don't have a lot of property, a lot of obligations that you need to be paying every single month. It's really easy to cultivate these things right now at a young age, because you don't have a lot of these big expenses to worry about, and you can really just start small, start building good habits now, so that when the time does come that you are paying like a mortgage, an auto loan, all that good stuff, you are going to have these great habits in place, and banks are going to really trust you and really give you some great terms on the loans that they actually do give to you. So even if you do have a high credit score, that's not the whole picture. That is just one aspect of a 5-step process that will actually allow banks to see that you are creditworthy and that they should actually lend you money. So that is it for the video, guys. I just want to show this topic to you guys. I think it's very important to know what lenders are actually going to look for in a loan to you. So if you guys enjoyed this video, do leave a like, do subscribe to the channel, and do share this video with at least one friend. I thank you very much for taking the time to watch this video. I hope you gained a lot of stuff out of it. I will see you tomorrow, and until next time.